One of the biggest topics to date has been the spate of merger and acquisition activity occurring in 2018. I'm Yvette Essen for AM Best TV, and Catherine Thomas, Senior Director of Analytics, is here to talk about some of the drivers as well as the challenges that companies may encounter post-acquisition. Starting with the drivers, obviously they're very diverse and companies have different reasons for wanting to buy another business, but perhaps you can highlight a few of the reasons why companies feel they are needing to go down this route.
Yes, so in the current very competitive operating environment, there is a perceived need to build scale and relevance, particularly in the reinsurance sector that's under pressure from alternative capital. So we're seeing smaller organisations targeted by peers that have a stronger presence in a particular market, and for the buyer they're looking to enhance their profile and their performance. What we're also seeing is companies identifying challenges to the sustainability of current markets or particular business models, particularly from technology, and looking to diversify to reduce their exposure to these threats. So what we've seen is companies that have access to data-driven technology, or companies that have a focus on less commoditized specialty lines business are proving particularly attractive. Now, to finance these deals, we're seeing some companies turning to relatively inexpensive borrowing, while in other cases we have cash-rich buyers looking to M&A as a means of deploying excess capital.
Now, post-acquisition, are companies using different strategies, going through different routes to integrate businesses?
They are, but these tend to relate back to the original motivation for the deal. So, for example, if you see similar businesses merging, the intention here tends to be improving relevance and scale. Therefore, the focus is on realising expense synergies and economies of scale. There's also an effort to minimise loss of business, but at the same time where there is overlap, companies need to be aware that exposures remain within tolerance. Also, so on the other side, where we see companies purchase that have quite different business to that currently underwritten by the buyer, we tend to see that the acquired management team remains in place and the takeover target maintains a significant degree of independence. Now, when that's the case, they can maintain some of the benefits of being a smaller organisation. So, for example, by being quite nimble and potentially more innovative. But at the same time, they now have access to the new parents' potentially quite large capital base.
You mentioned the word benefit there, but obviously deals can have their difficulties, they can have their hurdles. Can you explain to me, post-acquisition, what are some of the challenges that companies may encounter?
Well, one of the key risks is overpaying, which can erode shareholder value. There are also execution risks. When it comes to integrating staff and systems, there's the potential loss of talent. And also companies need to be aware of aligning often different cultures.
AM Best has published a report looking specifically into the M&A activity in the insurance and reinsurance markets. That report can be found on ambest.com. For AM Best TV, I'm Yvette Essen.